Good afternoon, and welcome to the Global Interdependence Center's first executive briefing of 2021. I'm Don Rissmiller, your host and GIC's Board Chair Emeritus. Today, we will explore growth and inflation in the U.S. and the fiscal and monetary policy framework. We'd like to thank Yeshiva University for partnering with GIC on today's event. As a reminder, this event is being recorded, and the replay and the slides will be available through the GIC website. Joining us today are Dr. James Kahn of Yeshiva University and Kevin Kliesen of the Federal Reserve Bank of St. Louis. James Kahn joined the economics department at Yeshiva University as department chair in 2009. Previously, he was a vice president in the research department at the Federal Reserve Bank of New York. Before that, he was associate professor at the University of Rochester. He was a national fellow at Stanford's Hoover Institution and has also taught at Columbia, Yale, the University of Pennsylvania, and New York University. Kevin Kliesen is a business economist and bank officer in the research division at the Federal Reserve Bank of St. Louis. He joined the bank in 1988. He holds an MA in economics from Colorado State University. In addition to his responsibilities at the Federal Reserve Bank of St. Louis, he taught part-time for the Department of Economics at Washington University from 2006 to 2013. Professionally, he is a member of the American Economic Association, the National Association for Business Economics, and the Association of Christian Economists. With that, we'll turn it over to our first presenter. Welcome, Dr. Kahn.
So I'm going to focus a little bit more on where we've been and how we got to where we are. So even though we're talking about the macro outlook for 2021, to better understand where we're going, I want to see where we've been over the past year or so. And I'll have a little bit to say toward the end of where we're going, and then Kevin will focus more on that in the second talk. So, just as a preview, I mean, the pandemic is obviously the major event of the last year, and it's kind of what an economist call a rather unfortunate natural experiment. Like a war or a natural disaster. It works very well in terms of our textbook understanding of economics. It's pretty easy to analyze what's going on and understand what's happened, and that helps us predict where the economy is going. So that's what, as I say, what I'm going to focus on. So if we can go to the next slide. So as we know, through the year 2019, we had a record 126-month, 10.5-year expansion. And the Fed, during those last couple of years, had been gradually tightening. They had contracted the balance sheet, reducing bank reserves. They'd been gradually raising the Fed funds rate target. And then in the course of that gradual tightening, there was a bit of a storm in the fall of 2019. The reduced bank reserves and general drawing out of liquidity created some turbulence, particularly in overnight lending markets like the repo market and the Fed funds market. And at the same time, there was also a yield curve inversion, which often signals trouble ahead. So go to the next slide. So this is the difference between the 10-year Treasury and 3-month Treasury, and of course, usually that difference is positive, but every now and then it turns negative, and you can see that frequently when it turns negative, it's followed by a recession, and it had turned negative in 2019 also. So between the turbulence and the inversion of the yield curve, there was some concern. Next slide, please. And so the Fed reversed course. So next slide. So you can see this is the Fed's balance sheet, and you can see what happened back in 2008 during the financial crisis. We had the initial quantitative easing and then QE2 and QE3 over the subsequent 5 years or so. And then around 2018, the Fed started unwinding these expansions and gradually drawing down the balance sheet. And then you can see that in the fall of 2019, it abruptly reversed course and started another sort of modest quantitative easing because of the liquidity problems and turbulence in these markets. Next slide. And you can also see that this is the federal funds target range, and you can see that they were gradually raising the Fed funds target, and then they also reversed course in that and began to lower that in late 2019. Next, please. So fortunately that storm passed, and solid growth continued all the way really into February. We had job growth averaging over 200,000 a month. GDP growth in 2019 was a solid, unspectacular, but solid 2.3%. And maybe more tellingly, the unemployment rate had fallen from its already relatively low 4% to 3.5% over the course of 2019. Next, please. That yield curve inversion reverted, and so the slope of the yield curve turned positive. The 10-year rate became larger than the short-term rate as the Fed began to lower these short-term rates. So the picture again looked quite good in early 2020. Next, please. Also, another indicator I like to look at is credit risk spreads. This is the difference between a kind of moderately risky corporate bond yield and the 10-year Treasury. And you can see that frequently goes up in scary times, especially in 2008. And nobody seemed too concerned. Again, at the beginning of 2020, the spreads, the yields were pretty tight. So everything looked pretty good. Next, please. Next, this is just a transition slide, so you can go to the next one, please. Then, of course, we had the pandemic, which really hit in March of 2020, and the kind of bottom dropped out of the economy. And this is a chart of output it's essentially like GDP. I'm using the non-farm sector output measure of production, and because it also gives us hours of work, and you can see that hours of labor fell about 15% by the end of the second quarter relative to the end of 2019. That's an extraordinarily large amount. Probably, I haven't checked, but I assume it's the largest in modern history. And output fell almost as much. Again, this is kind of a textbook idea that if you cut labor but not capital, then output does not fall as much as labor. So this is what I was alluding to when I said textbook economics works very well in these major events. So as a consequence, I'll just mention that productivity as measured, which is output per hour, actually grew enormously in the first half. We can go to the next slide, please. And then there was of course, this is a classic V-shaped recovery as the economy reopened somewhat in the third quarter. And so cumulatively, though, through the Q3, labor hours were still down 4% relative to the end of 2019, and output was still down 7% through Q3. So excuse me, I think I have those backwards, but 7 and 4%. So the point is that if you go to the next slide, the economy had only really recovered 60% of where it would have been if you just extrapolate the trend. The output decline was again, well short. I mean, the output recovery was well short of where it would have been had the trend continued. So that's where things stood. We don't have the latest, the Q4 GDP report that will come in a couple of weeks, and I'll talk about what that's likely to be in a moment. Okay. So as mentioned, output per hour increased, but that's not how we want it to increase. We want productivity to grow, but not by hours falling a lot and output falling a little less. Okay, next slide, please. So of course, there was a strong fiscal and monetary response. Fiscal stimulus, direct payments to individuals, loans to businesses, direct aid to specific industries. Monetary stimulus, as we'll see in a moment, a massive expansion of the Fed balance sheet through asset purchases and loan programs, really unprecedented intervention in private bond markets, and interest rates going to zero. So next slide, please. So this was the sort of sequel to the Fed balance sheet picture that I had up a moment ago. And you can see what happened in 2020. It dwarfs really what happened in 2008. A $3 trillion expansion of the balance sheet. It's effectively a $3 trillion lending program that the Fed promulgated. Next slide, please. They didn't mess around with gradualism when it came to the Fed funds rate. They dropped it immediately to the 0 to 1/4% range as soon as the pandemic hit. This was in March, and have left it there ever since, and have said that it will remain there for an extended period of time. Next, please. One thing that's different in 2020, which is going to get, I think, to the question, maybe shed some light on the question of inflation, is that this time, this is the money supply, the M1 money supply. And you can see that despite all the quantitative easings in 2008 through 2015, I mean, the money supply definitely grew, but the Fed was not really encouraging banks to lend out all these reserves that they were providing them through the quantitative easing, because that was where the trouble had been in 2008, kind of, irresponsible lending. And so there was nothing so dramatic in terms of the amount of lending and correspondingly the growth in the money supply. That's not true in 2020. The whole point was to get loans out to help businesses and individuals get through the pandemic. And so you can see enormous growth in the money supply. And it remains to be seen what that's going to do as the economy continues to recover. Next slide. So what was the intent of these policies? I'd say not primarily to increase GDP, because that was being held down by fiat. Okay, there were forced shutdowns and mandates and regulations to not produce goods, varying by sector, obviously, but that had tremendous impact on the more on travel and entertainment and other sort of leisure-related sectors, discretionary goods. So the impact was very uneven. But I would say the V-shaped recovery that we saw was mainly the result of the reopening and not so much the monetary fiscal policies. Those policies, I think we can make sense of them as their intent was to keep individuals and businesses from failing. So these were fundamentally solvent businesses and individuals who would likely have gone bankrupt, and that would have prolonged the downturn, because things would have had to start from scratch, as it were, in sectors where there were a lot of failures. People would have lost homes, their credit ratings would have been affected, and so forth. So I think the policies make more sense in terms of that. The economy could only recover and grow to the extent it was being allowed to via reopening. Next slide. So yeah, I think of it as a little bit like eminent domain. These businesses were forced to shut down, and in eminent domain, you condemn a property for a public purpose and you compensate the owner. But the idea is to help speed the recovery, as I said, If businesses are just shut down but they didn't fail, then they, when they're allowed to reopen, they can just turn on the lights and continue where they left off, so to speak. That's the idea. And individuals will still have their homes and their credit scores. Nonetheless, it's a very imperfect policy. The programs were very uneven and taken up in a kind of haphazard way. There were a lot of failures. And so as a consequence, and especially because of the resurgence of the virus in this winter, the recovery may be slow. And despite the advent of the vaccine, that's being rolled out slowly, and in general, the reopenings are going to proceed cautiously. And I'll just finish by saying I think inflation is more of a risk now than it was after 2008 because of what I mentioned before, that there's a lot of money out there. Eventually, it's going to be, consumers are cautious about spending now, but they're going to start spending, and there's going to be a lot of money chasing maybe not quite as many goods as consumers would like. So that's a risk that I see going out maybe late in 2021. Next. So just to finish the story, this was where we were with the V-shaped recovery. One more slide, please. And that's where I think we'll go. This is my back of the envelope forecast. This is more Kevin's department, but growth is going to continue, but it's going to slow as the low-hanging fruit has been taken. We still have the virus and lockdowns in place, but there is room for sustained recovery as the economy reopens, and the markets seem optimistic with the stock market remaining strong and the yield curve as upward sloping. So I'll stop there. Next slide should be the end. Thank you.
Well, Jim, thank you for sharing your insights with our GIC community. We'll ask you to stay on and join us after Kevin's presentation for the audience Q&A. Next, we'll hear from Kevin Kliesen. Kevin, the floor is yours.
All right. Well, thank you, Don, and thank you to GIC and your colleagues at GIC, in particular Colleen Murphy and Jill Fornito for arranging this. So let's go to the next let's go to the next slide. All right, so I'm going to give you my views on the U.S. economy and sort of the near-term outlook for the U.S. economy. My views are my views and not necessarily those of my colleagues at the St. Louis Fed or other colleagues in the Federal Reserve System. So let's go to the next slide. So, I'm in the forecasting business, and forecasting is difficult, to say the least, particularly during times of turbulence and high levels of uncertainty. Abraham Lincoln once said that the best way to predict the future is to create it. And if forecasting was that simple, we could all go home. But when it comes to tracking the economy, what I like to do is, as a first approximation, is to look at things from a 30,000-foot view. I call this the big picture. So from this standpoint, the U.S. and global economies have experienced two very major shocks in the past dozen years, and the pandemic shock seems to dwarf the global financial crisis. We'll see if it's as long-lasting, but clearly it's a shock of really unprecedented size in our lifetimes. Lenin, that would be Vladimir, not John, once said that there are decades when nothing happens, and there are weeks when decades happen. So, during the just several weeks earlier this year, just seen a staggering decline in employment and output. So history has shown that turmoil caused by these upheavals often lead to economic restructuring that can trigger sizable shifts in the supply and demand for capital, and for the final goods and services that these factors of production produce. So the bigger the shock, the larger the likelihood of significant changes in economic policies. These forces typically play out over years, not quarters. And not all of it is bad. Changes in relative prices, new technologies, and new policies often benefit those firms and workers that can best adapt to this quote unquote new normal. And that's kind of how capitalism and creative destruction work to a first approximation. The challenge is how to devise policies to help those that have been permanently displaced by shocks like the pandemic and its after effects that can linger for years. So those discussions and debates are taking place now as firms, workers, and policymakers begin to transition to a future where the worst of the pandemic, hopefully, is in the rearview mirror. So this transition to an economy dominated by what I call vaccine dynamics. This is where economic activity and outcomes begin to resemble kind of pre-pandemic landscape. Obviously can't come soon enough. So these dynamics hold the promise of much better health outcomes and economic performance. This transition obviously will be affected by the new administration that will most likely place different priorities on tax and expenditure and regulatory policies. But our republic has endured changes and transitions to different administrations now for quite some time. So this is something we've seen before. So all of these factors point to potential economic restructuring that could have sizable effects on the long-term performance of the U.S. economy and the global economy. It remains to be seen how the economy's structural underpinnings will look on the other side of the pandemic, but all in all, I'm pretty hopeful. So, this is an important discussion, but, probably one for another day. My task today is to lay out what I think is the near-term performance of the economy. I think the probability is very high that much stronger economic conditions will prevail this year and next year. Higher inflation, though, could accompany this outcome, but we have to remember inflation has remained stubbornly below the Fed's 2% inflation target for almost a decade. So any forecast really must account for these forces, which appear to be global in nature. Okay, next slide, please. So, as we enter 2020, I think the outlook is brightening, but still the pandemic is still out there and it's still raging in many parts of the country. You have rising COVID case counts, hospitalizations, and fatalities. They have spawned either renewed or new containment measures in many states and metropolitan areas. I think in large measure, these new measures really had a profound effect on the December employment report, which was jarring in many ways. There was just a huge decline in leisure and hospitality jobs, almost 500,000. Now, there were some silver linings in the report. We had upward revisions over the past 2 months in some sectors like manufacturing, construction, professional business services. They cumulatively increased payrolls by a pretty significant amount, but nevertheless, the decline, there was a decline on net. And it's important because the labor market is really a key barometer that many economists and forecasters look at as a indicator of current economic conditions. Consumption is another key indicator that economists look at. Here we've seen some mixed signals. November data was pretty weak. December data looked better in many regards. We had a pretty good uptick in light vehicle sales. some of the weekly retail sales and credit and debit card measures that we track also were higher on average than November. But tomorrow morning we'll get the retail sales report for December to see how this shake out. But I just remind people that the retail sales report excludes services, and services are by far the largest component of personal consumption expenditures. All right, next slide, please. Now, other parts of the economy actually look pretty good, in particular manufacturing and housing. In a typical recovery, what happens is that inventories build up, and as firms run down those inventories and demand picks up because the Fed is lowering interest rates, that really helps the interest-sensitive sector of the economy. And that's kind of what we're seeing now. We're seeing kind of a normal cyclical rebound in the goods-producing sector. And that's good. Now we're probably going to get some more fiscal support from Treasury, and I guess the President-elect will speak tonight and sort of outline his plans for what he would like to see in the next round. The Fed is probably, as many senior Fed officials have said over the past week or so, and today Chair Powell, yesterday Vice Chair Clarida sort of outlined their view of where they see monetary policy going over the next, say, 12 months or so. So it looks like the Fed's going to be on the sidelines for the foreseeable future. But again, who knows what the future will hold. Hopefully we get a really big uptick in the economy. That's kind of the intent of these policies anyway, as Jim kind of laid out. So we've got a euphoria in financial markets, in part because of these policies and the expectation of faster growth. But I think really one of the key factors driving this euphoria and the expectation of much faster growth is the promise of the vaccine, and again, how it can really lift the services sector, which has really just been hammered by the virus. So there's a tug of war going on. On the one hand, you have forces leading to more weakness, and then on the other hand, you have forces leading to more strength. Clearly, I believe that the latter will prevail. Maybe not immediately, but clearly we think over the next 6 to 9 months, or the last 6 to 9 months of the year, we should see pretty good growth. Next slide, please. Now, I think I've done some research on the effects of uncertainty, and this is pretty important, I think. So the fact that uncertainty still remains extremely high is something we need to account for. When uncertainty is very high, it causes firms and households to really change their behavior. Firms can sort of pull back. Maybe not hire as much or not hire. They could postpone capital spending. Households could sort of postpone spending and increase their savings. So you could see an increase in precautionary savings. So all that tends to have a dampening effect on growth. So the good news is that uncertainty is coming down. So really the tail risks, what I would call, that you saw really at the end of this chart here on the right, where you saw uncertainty really spike. Obviously, the probability of this tail event where the economy would really tank, and not to say that it didn't, but the fact that it might have been a prolonged downturn, I think that tail risk is now coming out of expectations of firms and households. All right, next slide, please. So here's my narrative in a nutshell. I think it's clearly been a unique recession. So a unique recovery is likely. As I mentioned earlier, the goods producing sector, it's more interest sensitive. That seems to be doing well. Even some services sectors, those tied to financial markets, also seem to be doing pretty well. Now, what we're really hoping for, though, is that these vaccine dynamics that I talked about is really going to cause the services sector to come back big time. And I think this is important because if you look at sort of services sector output as a share of national output, it's around 70%. So clearly not all of the service sector is impaired, as I just mentioned, but a good chunk of it is. So I think once these vaccine dynamics kick in and we really increase the number of individuals who are receiving the vaccine, I think that will lift business and consumer sentiment significantly, and that will lead to a pretty sizable increase in the demand for services. Now, obviously, some services prices have been depressed because of the pandemic, just simply because demand effects. So as demand picks up for some services, maybe those related to travel and leisure, you probably will see some upward adjustment in those prices, and that could obviously lead to higher inflation going forward. Now, from a broader perspective, I think the fact that you have rapid growth, large budget deficits, or larger budget deficits probably, and even the Fed's new policy framework, the Fed has been pretty explicit that it wants to get inflation back up to its target, and in fact, maybe even run inflation a little bit above the target for a while. So the worry is this could spur higher inflation and raise inflation expectations. I think we need to remember what Milton Friedman told us. He reminded economists that inflation, it can take a while to really get going, and he said this is not measured in quarters but in years. So it could take a while for inflation to get going if it gets going, but I think ultimately inflation, as he pointed out, is a monetary phenomenon. So you have to really have monetary policy at the end of the day really causing inflation and inflation expectations to pick up. But again, as I mentioned earlier, you have these global forces that have really worked against or worked to keep inflation pretty low, not just in the United States, but many other countries in the world as well. So all of these factors, I think, will begin to raise market interest rates. The demand for credit picks up, maybe some uptick in inflation. So the inflation premium built into nominal interest rates will increase market interest rates as well. All right, next slide, please. So what are the risks? Well, first of all, let me just say that this is kind of key to the story. This is a chart that shows household time and savings deposits. So if you look at the right part of your chart there, I just drew in a simple linear trend line. So there's a lot of household savings and time deposits out there. So if you do get this saving, going back to trend, this would equal about 875 billion, and that could boost consumer spending by about 6%, and the boost to GDP, depending on how the composition is spent, could be 3 to 4%. Next slide, please. So here's the Fed's outlook. I'm not a big fan of point forecasts, but I think the bottom line here is the Fed is seeing much above trend growth this year, next year. The unemployment rate coming down in 2021 and 2022, and inflation just kind of slowly creeping up to the 2% target. Next slide. Let me just quickly go through kind of a risks here. One of the risks, obviously, is the vaccination pace has just really been very slow. What I did here is there's two trend lines. The initial rollout was pretty slow. It's picked up a little bit, as evidenced by the higher trend line, but still, even you run this out to the end of March, and you still only have 18% of the populace vaccinated. And for purposes of comparison, it's already up to about 25% in Israel right now. So clearly, the U.S. is kind of getting slow out of the gate. So we really need vaccination pace to pick up, and that is really a key part of my story. And then I'll just end with the next slide. And obviously, one risk is perhaps you get inflation, and inflation expectations really beginning to pick up. And here I'm using inflation expectations from a couple different measures. One is inflation swaps, which is a inflation derivative, and inflation expectations that come out of Treasury securities. And sometimes they're correlated pretty highly with oil prices, which have also picked up. But I think at the end of the day, it's hard to see how an increase in oil prices now will persist over this horizon. So we tend to look at those two things over a longer horizon a little bit separately. So anyway, thank you again for listening. And Don, I'll turn it back over to you for some questions.
Okay, well, thank you very much for that perceptive presentation, Kevin. And now we'll go to our audience Q&A. I'd like to remind our attendees that you can enter your questions for our speakers under the questions tab on the dashboard. We have quite a few questions coming in on inflation, and the first one tries to square the pretty large output gap that seemed to be described by the forecast. We're still not back, even if we've had a V-shaped bottom, to the prior trend in activity with the inflation risk. So the question, and I'll go to Jim first, is are we really talking about an inflation problem, or is this more of an inflation scare as prices adjust in 2021?
Well, first of all, I think the concept of an output gap is pretty tricky in this context because I don't think you want to think of output relative to that trend, say, that I had in the in my graphs, because that's extrapolating, from pre-COVID times. The capacity of the economy is really constrained by the shutdown, the policies that have been put in place to, social distancing and restrictions on business activity and so forth. So I guess you can think of that as kind of a supply shock. Now, there's also been a demand shock because consumers don't, want to go out and spend and travel and do the things that they've been doing. But I don't think you want to think of the output gap as being so negative because, the capacity of the economy to actually produce goods has been diminished by the social distancing policies. And so the question is, there's kind of a horse race. If consumers become more optimistic and start spending those quantities that Kevin had shown in his graph, and if that happens, kind of ahead of the economy really reopening, then I think we could see. I think that's a more accurate indicator of inflationary forces than just looking at the traditional output gap.
And Kevin, maybe if you want to follow up.
Yeah, I would just echo what Jim said. There's a couple points. One thing is the output gap is just, as Jim indicated, is just very poorly measured in real time. Athanasios Orphanides and Simon Van Noorden had a series of papers, 15, 20 years ago, just showing this. The second thing, as I would say, is that we at the St. Louis Fed have always tended to believe that inflation expectations trump the gap, and I think that's kind of where Jim came out at the end of the day. So I would tend to look at inflation expectations more than the output gap as sort of a measure of future inflation pressures. But I don't want to put words in Jim's mouth.
No, I agree. I didn't mention the expectations component, but that's part of it too. And I think that's add on to that what you mentioned about the Fed's change in kind of policy directive that they actually want inflation to go above the target. That together with the traditional big increase in the money supply and the potential very constrained reopening. Now, even with the virus starting to get distributed, there's a lot of reluctance both on government officials and individuals to go out and party and return to the pre-COVID habits and activities. So There's concerns raised about whether people, how effective the virus will be, whether people can still spread even after they've been vaccinated and so forth. There's a huge amount of caution. I think people have been very frightened, and I think so there's not going to be a big sudden resurgence of economic activity or reopening. And so again, as I said, it's this tension between consumers maybe starting to want to spend more, but business is not really able to get back in gear and supply all those goods that will also play a role in addition to the expectations. It's hard to whatever's rules have worked in the past may not apply so easily in these circumstances that are, as you say, unique.
It seems we've hit a nerve on the inflation front. There's quite a few other questions on this topic. So the next question here is on the inflation statistics, and it's really, should we take them at face value? Do you have any concerns about the inflation statistics as they're calculated? Hedonic adjustments are mentioned, but also, will we really have to see a sustained increase in wages before we have an inflation problem? So Kevin, why don't I go to you first there if you wanted to offer some initial thoughts.
Okay, well, on the latter point, I think, the St. Louis Fed obviously has had a different viewpoint on many things over the years. But our view tends to be that, again, it's the causality runs from inflation to wages, not the other way around. So I would look for inflation expectations driving wages higher, not wages driving inflation higher, because that brings in other things like productivity and unit labor costs and things of that nature. On the price measurement front, the thing I think the thing you can legitimately say is that the pandemic has probably distorted price signals on many goods and services, and the BLS may have had some issues. I don't know for sure. You hear anecdotes here and there, may have had some difficulty in measuring certain prices and services during the pandemic. So, once the pandemic sort of works its way, sort of ends, and prices then can adjust. So you can see maybe prices behaving unusually over the short term, but then I would expect them to adjust to something more normal going forward after that.
And Jim, did you have any thoughts?
Yeah, I mean, on the measurement thing, I think that's right. First of all, one of the challenges in measuring inflation is when the goods that are being bought and sold vary a lot over time. And certainly during the pandemic, we've seen huge changes in the composition of economic activity. And so when you try to come up with a single number for a price index when the economy today is producing very different goods and services than were being produced a year ago, that is a challenge. And so I think, I don't know how that affects things, but as an example, it seems that there's been a lot of sort of effectively rationing. We've seen shortages crop up. Well, that suggests that prices aren't going up to clear the markets. And that means that maybe, the true prices would have been higher, but there was, reluctance to raise prices for fear of, looking like price gougers and so forth. So that kind of phenomenon also makes measurement difficult. So yeah, as Kevin said, I think it's going to take some time before we can get a good read on what inflation truly is. But we should take the current numbers maybe with a little bit of grain of salt.
So maybe to shift gears a little bit, and Jim, I'll stay with you. If we think about the nature of the shock, the burden has fallen in many cases on those least able to bear it. And so it's been a very unequal recovery thus far. How should policymakers think about that? Is that one of the strongest arguments for monetary policy staying easy? Does that mean more fiscal policy needs to be done? Are there other things we should consider?
Well, yeah, I mean, I think traditional monetary policy does not really address those sorts of inequities directly. I mean, there there may be some effects, but as Kevin mentioned, it tends to, work through interest rates, and it's not really targeted at, addressing sectoral issues. I mean, the Fed doesn't. I used to be at the Fed. I don't want to speak for the Fed, but I think they explicitly try to stay away from saying, well, we want to help this sector or this demographic. Their focus is on the economy as a whole, and that's what the policy effects tend to be. So it's really more through fiscal policy that these sorts of things can be addressed. Now, some people have said that the Fed is really doing fiscal policy through its lending programs and so forth. And so certainly the non-traditional policies that the Fed has been doing have been addressing that. As I think I mentioned toward the end in my slides, that's really, I think, what they were intended to do, that they're trying to help those most affected adversely by the pandemic to get through, to muddle through somehow, to not lose their homes or their businesses. And then, of course, the $1,200 or the $2,000 or whatever, those are designed to address that inequity as well. But it's, inevitably, when those are all very imperfect policies that only, barely get at the problem that they're trying to solve.
Kevin, did you want to follow up?
Yeah, I would. I think Jim answered that pretty good. I would just add, the Fed's new framework kind of implicitly talks about this when it said it's going to look at shortfalls of employment rather than deviations from full employment. And I think the idea is that in a low inflation environment, the Fed is no longer going to be preemptive. If the unemployment rate either falls to or falls below, some measure of the natural rate of unemployment, just simply because the Phillips curve is so flat now. So I think part of the rationale or for the new framework is again to remove this preemptiveness and just run the economy hot as long as inflation is low, to really help those at the lower end of the income distribution. And we saw, before the pandemic, we saw that those in the lower end of the income distribution were seeing pretty strong gains, and poverty rates were falling for many minority groups. So that, I think, is something the Fed looked pretty favorable on. But again, this all depends on sort of running a policy that is consistent with the Fed's dual mandate of price stability and maximum employment.
So we have quite a few questions on debt, and maybe Kevin, if I stay with you, are you concerned about the increasing budget deficits and debt numbers, or is this an appropriate policy given the type of shock?
Well, there seems to still be a huge demand for safe assets, and it's hard to find a safer asset than U.S. Treasury securities. So at this point, maybe that's the appropriate policy. I don't know. Fed typically doesn't like to tell Treasury what to do. So, I think one of the challenges is that we don't know where the threshold is. At what level of how high does Treasury debt have to go before investors really start to demand an interest rate premium to hold that additional debt? We just don't know where that is. If you look at Japan, their debt to GDP ratio is twice as much as ours, or maybe more. So at this point, I think the policy is probably appropriate to borrow at very low interest rates to get us past the pandemic and maybe invest in infrastructure and some other things. But at the end of the day, you're basically saying that you're going to have to raise taxes to pay off this debt, or you're going to have to pay it off through increasing the money supply, because we're not going to default on it. So those are the two things.
And Jim, any follow-ups?
Well, yeah, I take a little bit maybe more negative spin on it. I think it's maybe appropriate now, but you'd like to see a kind of a credible plan for unwinding it, just like we want to see, the plan of the Fed in maybe unwinding some of its balance sheet expansion in a credible way to get back to sort of a normalcy. The problem with the buildup in the debt is it's very hard to reverse. It's very hard to have those tax increases relative to spending that end up bringing the debt or debt to GDP ratio back down, except through inflation. If we look back at, historically, the largest debt to GDP ratios have ended up coming down more through inflation than through fiscal surpluses. So that, again, makes me feel somewhat uneasy about the future path of inflation. Again, not in 3 months or 6 months, but as Kevin mentioned, over years, unless there's a credible plan to cut spending and or raise taxes. And again, a lot of the spending is temporary, but let's hear the plan. And I think that would give some more confidence to financial markets ultimately, to the extent they're worried about inflation being excessive, that this will be avoided.
Well, thank you. And Jim, maybe I can address this question to you, but with the new administration, we could have some changes on the global trade front or with trade wars, and that could play into the dollar and currency markets. Is that important for your outlook? And do you have any thoughts in that space?
I don't think it's a major factor. I suspect that this administration will sort of pull back on some of the trade war threats and language, and be a little bit more open to sort of globalism than the previous administration. But I think these effects are small relative to what's going on with the pandemic and with the reopening and those factors. I mean, those are things that we would maybe be more concerned with in normal times. But as I mentioned at the outset, the pandemic is such a huge thing that it dwarfs everything else. And so I think it will be good long term for the economy to have a clearer trade policy that's a little bit more maybe more rational and more receptive to the gains from trade. In terms of the dollar, I think that's going to be affected by monetary policy and interest rates relative in the U.S. relative to what's going on in the rest of the world. So we'll see what happens there. But in terms of the unemployment, inflation, GDP growth picture, I don't see the trade situation as having a huge impact.
So Kevin, maybe I could come to you, and we have a number of questions on the level of longer term interest rates. And the question would be, is there a number that scares you if we were to see a surge? Is it the speed with which we rise? Because I think there's a general consensus we could see rising interest rates, and if the economy is improving, that could be a good thing. But what would be a sign that this might be something we need to worry more about, or is there a threshold we need to stay below?
I don't know. If you look back in late 2018, the 10-year Treasury was about 3.25%, and it's a shade over 1% now. So, it seems to me like the runway's pretty long in terms of where long-term interest rates will go. I've seen estimates from models that try to measure what the fair value is, and that's somewhere around maybe 1.25, 1.5, who knows? Again, these are model-based estimates. I think, at the end of the day, if nominal interest rates are rising because the real rate is increasing and inflation expectations are relatively stable, I think that's a good thing. The Kliesen Fed does this breakdown on their website where you could look at the composition of the 10-year nominal treasury rate in terms of the real yield and the inflation premium. So that would be one place to look. So I think, as the economy picks up, as I mentioned, and the demand for credit picks up, that's going to naturally lift interest rates. The wild card, obviously, is Treasury debt issuance seems to like it's going to pick up big time as well. So that will be an added pressures.
And Jim, did you have any numbers on interest rates that would cause you concern?
I mean, I think it will be gradual. They will go up. I mean, as I mentioned earlier, the Fed has said it's going to, keep the Fed funds rate target low for probably the bulk of 21. Things could change. I would expect, if anything, rates will go up a little faster than are anticipated, and we're already seeing some increase in the longer term rates. And they could well be back up to the 10-year could be well be back up to 3%, by the end of 21 if the economy is recovering. The concern really gets back to the debt issue because the deficit is what it is now at zero, close to zero interest rates, and if the interest rates start to get up to more normal levels, that's going to exacerbate the deficit, and you can have a cycle with inflation feeding into the deficit and creating more imbalances. So, if the 10-year starts to get up because of inflation up above 5 or 6%, a couple of years from now, that's going to maybe create a little bit of a circular or self-reinforcing problem that becomes inflationary. So that's the risk. I put a little bit of weight on that, despite the fact that people have been talking about inflation for a long time, and it never seems to happen. At some point, it may, and we ought to be on guard for that.
We have another question on some of the downside risks, in particular, some of the new virus variants, the mutations that seem to be coming out. So we may not be through this yet. Do we have to consider that as the primary downside risk, that it's the virus, or are there other things that you would want to factor in? So maybe Jim, if you wanted to start.
So from what I understand, I'm not an epidemiologist, but from what I understand, the new strains, first of all, are affected by the vaccine. The vaccine is effective against these new strains, so the continued vaccination will still work. Also, the new strains don't appear to be more deadly than the previous ones. But I think a lot of this is psychological. Again, our consumers going to be scared. And maybe even more important, will we open up? At some point, we're going to have to decide whether we accept, what level of risk is acceptable, and trade that off against the costs of being shut down. And so I think it's less medical than it is sort of psychological and policy related. Will we learn to tolerate a certain amount of risk and press forward with reopening the economy? My epidemiology understanding suggests that everything is going to likely recede. The virus rates and infections and so forth will recede as warmer weather comes, as they did, this past year. And so I think that, and that will give a little bit more of a window of opening for vaccinations to proceed. So I think things look pretty good for the second half of the year as far as that's concerned. So I don't see that as a huge risk, as long as we can wrap ourselves around the idea that we can't eliminate the risk entirely, but we need to reopen.
Kevin, maybe I'll give you the final comment here if you have any thoughts on this topic.
I outlined some of the risks I thought to the near-term outlook. I would just go back to late 2019. The NABE, National Association of Business Economics, puts out a quarterly forecasting report, and in each quarter they ask the forecasters to list their major upside and downside risks. And in late 2019, nobody had a pandemic as a downside risk, and that's kind of natural. I mean, that's something you can't predict, nor should you try to predict. So, who knows what the next big risk will be? We just have no idea. So I think the best thing we can do is just sort of prepare ourselves by implementing good policies and trying to stabilize the economy as quickly as possible. So I just end it there.
Well, Kevin, Jim, thank you both for a fascinating discussion and for spending time with the GIC community. We hope that you'll each be able to join us for a GIC program again soon, and please be safe until then. As a reminder, before we close, the replays of this, as well as prior episodes of the executive briefing, are available on the GIC website. GIC is excited to announce that our next executive briefing on Wednesday, January 27th, will focus on the Israel-UAE Abraham Accord. We're delighted to be joined by Dr. Lewin of Ariel University and Dr. O'Brien, formerly of Abu Dhabi Investment Authority. Registration is available on the GIC website. To find the replays, explore GIC membership, or learn about the David R. Kotak Global Healthcare Series, please go to our website at www.interdependence.org. As we conclude, we encourage you to take 60 seconds to respond to our audience survey. Your feedback is important to us, and we appreciate you letting us know how we can improve our programming. Thank you for your attention, and good afternoon.